Good afternoon and welcome to the ASEAN Midday Market Watch. Our guest today is David Kuo. He's the founder of the Smart Investor in Singapore. David, great to have you on the show again.
Selamat Tanggahari, Brian.
Terima kasih. Now, let's take a look at how markets are performing. We've got the SGX at 2,921.73. It's down 0.46%. Bursa is down 0.5% at 1,598.04. Now, looking across the region, it's mixed. We've got the Nikkei at 30,290.31. It's down 0.58%. Shanghai Composite is up 1.43% at 3,655.09. Hang Seng is up 0.65 also at 30,946.10. But the ASX is down 0.41 at 6,889. And rounding off, it's the Kospi, also in negative territory at negative 1.08% at 3,128.95. David, what's your view on how markets have performed today?
Well, I think markets are trying to feel their way at the moment. They're trying to feel their way around all the things that are going on, Brian. So we have hopes of a recovery. We have a vaccine available now to many economies. The question now is how quickly can they get their needles into the arms of people around the world?
Yes.
And the faster they can do that, maybe the faster that we can get some kind of economic recovery. But, you know, the other side of that is I think a lot of the stock market investors are looking at those 10-year US Treasuries, and that is beginning to rise ever so noticeably at the moment. 10-year Treasuries in the US are now about 1.3%. So I've always said that there were a lot of investors in the stock market, reluctant investors, people who didn't really want to be in equities, but they had no choice. But now they have got a choice because they can say, I can come out of the stock market if I want, and I can go into those 10-year Treasuries and earn that safe 1.3%. Is that better than taking the risk in the stock market, which some people say are too expensive? So I think it's a balancing act right now, and that is what is going on in the markets. People are trying to decide where they want to put their money in 2021.
Now, yesterday, Singapore's budget 2021 was unveiled. Now, what's your view on the key takeaways from that budget?
Okay, I think if you have a look at the Singapore budget, you can probably read across from Singapore to the rest of the world. I think most economies will be in a similar situation. In other words, they're going to have to spend a lot of money. Governments are going to have to put their hands in their pockets and try and support as many businesses, as many people as possible. So government expenditure is going to go up, Brian. And at the same time, government revenue, tax revenues are not going to be that robust, not going to be that resilient. So consequently, what you have is revenues not very great, expenditure much higher than that. So you're going to end up with a budget deficit. And I think this is going to be repeated everywhere else in the world. Luckily for Singapore, the budget deficit doesn't actually mean that the government has to go out and borrow money, and it can dig into its reserves, and it's going to be using its reserves, although it will have to pay back that money at some point in time. For other economies around the world, they don't have that luxury of the reserves. And what it will mean, of course, is that they're going to have to go out and borrow the money in order to balance that budget. And some economies are not going to be able to balance the budget over the economic cycle, but Singapore is hoping that it can do so. So budget deficit this year, budget deficit, smaller one next year, and then after that, hopefully the tax revenues will start coming in, and then they'll be able to have some kind of surplus, which they can then use for repaying the reserves, you know, that they had to dip into.
So again, that's a classic Singapore, very prudent financial management. And again, they have, as you correctly pointed out, the luxury, like Norway, of borrowing from their reserves and not basically borrowing money from the market in order to fund these deficits. But what does this budget have implications on investment and investors, short-term as well as long-term, David?
Okay, well, I think what it is telling us is that there is going to be a two-speed recovery. There's going to be parts of the economy that is going to be doing particularly well, and there's going to be other parts of the economy that will probably be on life support for quite some time. and the ones that are on life support will most likely be the hospitality industry, the travel and leisure industry. I think that part of the economy will require a lot of help from the government. And the government doesn't really want to just simply throw that to one side and say, sink or swim. It doesn't really want to destroy that part of the economy. And we hear something very similar in the UK. They're saying the arts and culture side in the UK, the theatre is dying at the moment, West End is dying, and those kind of industries are saying to the UK government they need help. But going back to Singapore, I think what it's telling us is that one part of the economy, things like manufacturing, maybe high tech, finance is going to be doing okay. The other side is not going to be doing okay. So if you're an investor, yeah, go and have a look at the parts of the economy that is going to be pretty strong. And this is what we refer to as the K-shaped recovery. It's the letter K. So you have the upward slope of the letter K, and these are the industries that will continue to power along. Then you have the other leg of the letter K, the downward pointing leg, and that part of the economy will struggle for some time. So if you're an investor, look for the upward leg. And as far as the downward leg is concerned, it will recover at some point, probably not in 2021, but maybe 2022 and beyond. And if you have got the patience, then look for those stocks that are relatively cheap, buy them, and I think you'll be okay.
Now, speaking of stocks, what advice would you give investors in the year of the ox? Now, this is currently a very frothy, bullish situation in markets, and some are predicting that it's just the peak just before a crash. Now, what are your views on that?
Well, you know, I go back to something that Peter Lynch said, one of the greatest investors of our time, growth investors. And what he was saying was that nobody ever rings a bell at the bottom of the market. Nobody ever rings a bell at the top of the market to let you know that this is the peak and it's not going to go any further than that. And I think that is the kind of attitude that you need to take. You need to compare what is available in the stock market against what is available elsewhere. And you know, right at the very top, we were talking about bond yields. 1.3% is the risk-free rate at the moment. If you buy that, you're going to get 1.3% for the next 10 years. If you're happy with that, then go right ahead. But at the same time, you have a look at the stock market and you say, well, is it really expensive? If all the companies in any particular index were to pay out all of their earnings as dividends, in the case of Singapore, PE ratio of around what, 12? So it means that the earnings yield's about 8. So if all the companies in Singapore were to pay out all of their profits as dividends, you would get an 8% yield. You compare that 8% yield, earnings yield, against 1.3% treasury yield, I take that.
It's a no-brainer. Absolutely. David, thank you very much for your insights.
You're welcome. Thank you.
Now, we've been speaking to David Kuo, the founder of the Smart Investor in Singapore. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.